frame, from the higher time frame down to the time frame of taking an entry. Okay. So with that being said, every single day there are key things I like to know or I like to look at on the markets. But before that, I will like to see something that supports my trade idea on the microeconomics. That's the fundamental basics. I'm talking about forexfactory.com. There are many other ways to study fundamentals, but the summary of it all is that we just need to know whether we are going to have a high volatility day, a low volatility day, or a no volatility day at all, or we are trading in a day when we should not be trading, days like the NFP week. In the NFP week, you are supposed to stop executing trades by the Wednesday New York session of the NFP week. All right, I hope you are taking note of these things. New York session on Wednesday of the NFP week, the first week of every month, it shouldn't be found in a trade. Then news events like the FOMC, because most times the FOMC news are released around the 7 p.m. to 8 p.m. GMT+1, and that doesn't align with our bias for trading time and price. We would like to trade in a time where it favors or there's a lot of liquidity in the markets. I'm talking about the London or the New York session. Every other session has very low volume, so we don't want to be executing by that time. So that is why FOMC is not even a news to trade, except if you are doing position trading, short-term trading, or swing trading. Then news events like the CPI also, you would like to stay on the sidelines until after the CPI news release, because before the CPI news, most of the times, price action is going to go into consolidation. It's not going to move in one side, or it's not going to give us one direction. So you're most likely going to chase price action, and you don't want to be chasing price. You rather have a bias and wait for price action to come to you, then you engage. All right. So what are we looking for on the forexfactory.com? We just come to Forex Factory and we click on calendar. Then you are studying all of these boxes of different colors. You like to trade in a day where you have high or medium impact news events. The yellow boxes signify no impact at all or very low impact. The orange boxes signify medium impact and the red boxes signify high impact, excluding the days CPI, FOMC, and NFP news events. Is that correct?
Correct.
All right. So,
excuse me, one second.
Yep.
Question, please.
Yeah, go ahead.
Will I have a recording of this class, of all the classes?
I'm recording it for you already.
Okay, thank you.
But if you can record from your end also, you could.
I'll just stick to your own recording. Thank you.
Okay, then. So, look at Monday, the Monday 9th September, you could see that we literally didn't have any medium or high impact news event on the assets that we like to trade, the dollar, the euro. You see that there's nothing like that. So that was why all through Monday, it was a day for consolidation. So just by seeing this, you're going to save yourself the time trying to check charts, trying to look for entry, because you've done your overview, your micro analysis, and you already know that today we are not going to, it's not most likely, we're not going to have trade. Okay? Then you will be confluencing a high impact news event with something called the weekly market profile. The weekly market profile shows us how that an asset in a day trading profile will most likely form the high of the week. If we are bearish on the higher time frame, we would have price action form high of the week between Monday, Tuesdays, and a very few times on Wednesday. Then we sell off from the high of the week going into the rest of the week. And on Thursday or Friday, we anticipate price action to form the midweek reversal. Does it make sense?
Could you please take that again?
I said that weekly market profile literally shows us how price action will form high of the week, if we are bearish, for example, so let's say on the daily candle or on the weekly candle, if we are bearish, price action will first open. Price action will first open, then trade a bit higher from the opening to form high of the week, then distribute from that high lower because we are selling. This is on a weekly candle, right? To form the low of the week as well. Then finally reject to close above the low of that week. This is weekly market profiling, one weekly candle. On the lower time frames, like the 1 hour, this is how it will look like. Price action would form, let's say, possibly take our liquidity to form the high of the week, create shifts of market structure bearish, return into internal range and keep selling until it gets into the weekly objective, which is possibly an old low if we are selling. Price action trades into that and rejects to close inside the range. Okay? Does it make sense? So we have high of the week, price opened here. This is the opening, formed high of the week on Monday, Tuesday, or Wednesday, depends. So you see this happen on Tuesday because 75 of the times it forms on Tuesday. Then starts distributing into Wednesday, Thursday, and Friday. It gives us a little bit of reversal.
Hello, can you hear me?
Yeah, I can hear you.
But I just sent a chat to you that I can't hear you. So the last I got was at the close of the weekly candle. Then you know.
Okay, sorry. I think that must be network or something. So I was saying that this is on the weekly time frame, weekly market profile in one candle.
Yes.
And on the 1 hour or lower time frames, you see it happening this way, where price action will open, let's say around this level, then trade higher on Monday, Tuesday to form the high of the week. 75% of the times, the high or low of the week forms on Tuesday. Then distribute lower, shift of market structure. We start selling, reaccumulation, distribution into the weekly objective, and price will close inside the weekly candle. That is weekly market profile for a sell model. Okay? Are you with me?
Yes, I got it.
In a week where we are bullish, we would see it happen like this. Price will open, consolidate for a while. Maybe I'm giving you another scenario. Then go lower to form the low of the week. All right, then create shift of market structure and we start buying. This will happen maybe around Monday, Tuesday, or Wednesday. 75% of the times it happens on Tuesday. We start to buy into higher time frame objective for the week. Higher high, higher low, higher high, higher low. And on Thursday, price action may create the weekly reversal and close inside the range on Friday with a consolidation.
Okay.
Does it make sense?
Yes.
This is weekly market profile for a buy as well. So we are confluencing the high impact news on the economic calendar that's going to form on that Monday or Tuesday, especially on dollar or dollar associated pair. Around the time that event is happening and the day it is happening and the asset it is affecting and the type of impact, we will confluence that with weekly market profile to anticipate something called the high or the low of the week. Please remind me so that we'll have in one of the sessions, just remind me that I mentioned something about CBDR and I mentioned something about standard deviations. Is that okay? Are you hearing me? Are you there?
Yes. Sorry, I don't know if it is your network or mine. So at some point it goes off. So please, while you're
that's how it works. Crazy. So I hope you can hear me now.
Yes, I can hear you now.
I was saying that you should put it in your journal that I mentioned something about CBDR and standard
Yes,
deviations. Please remind me in one of our sessions. Let me talk about it.
Okay.
Yes. So I will show you how to catch specific highs or low of the week. Or low of the day as well. You get?
Yes.
All right. So once we are done analyzing the economic calendar, we know that, okay, on Monday, there's no high impact. We are not trading. On Tuesday, we have a high impact on GBP by 7 a.m. So most likely GBP is going to pose some level of volatility. On Wednesday, we still have high impacts. You see CPI on the dollar on Wednesday. So literally, you should know that on that Tuesday, you shouldn't be trading until after the CPI news. Or if you have the skill set to trade CPI, it comes with time, it comes with experience. Okay?
Okay.
Then you go to the dollar index and first analyze the dollar index from the higher time frame down to the lower time frame of entry, because the higher time frame is the main driver of price action. It's where the drawn liquidity resides, because that is where institutions actually take their trades. So today we are just going to study how to identify order flow from the monthly time frame down to the entry to frame our trade setup. Okay? So on the monthly time frame, there's something you are looking for. You're looking for three things on the monthly time frame. You are studying how price action has reacted previously, what it has done previously. Okay.
Okay.
Number two, where price action is at the moment is called the current order flow. Then number three, you're identifying where it is most likely going to trade into in terms of identifying drawn liquidity above highs or below lows. Is that clear?
Yes.
That being said, we look at the dollar, and if I was going to analyze the dollar all over again, what I see happening here is that previously we see the dollar from this moment, the dollar has been bearish, took out external range liquidity below that low, correct?
Correct.
And if that happens, we already know by basic knowledge of what you are studying now, elements of a trade setup, we are supposed to return into internal range.
Correct.
All right. So an all-time low was taken here. Price action started to form higher, high, higher, low, higher, high. You see that? Higher, low. Again, price formed another higher, high. But at the moment, we will look at the previous price range from the previous high to the previous low. Did you notice that price action is currently in a deep premium? I hope you understand what a premium level is.
Yes.
Yes, using your Fibonacci to measure a price range. As price trades above 50%, you are in a premium market. As price trades below 50%.
Sorry, I don't know how to use the Fibonacci. I don't know how to use that.
Okay, so Fibonacci is simple. Just add it up, or you just go to all right, so you click here by my left, you see that? Once you click there, you can see the Fibonacci retracements. Once you click on favorite, it's going to come up right here where you can easily access it here.
Okay.
Okay?
Okay.
All right, so once you click on that Fibo level of Fibonacci retracement tool, you measure, drag it from a high to a low, or a low to a high if you want to measure retracement. So drag it from a high to the low. You see that?
Yes.
You see that mine is
no setting of any other kind, just to add it to your favorite.
I just want to leave it as basic as it's 0.00 50%, 100.00. That's all we need.
Okay.
Okay. So if it goes above 50%, you're in a premium market, you sell. If it's below 50%, you're in a bullish market, you buy. So look at what happened here. Price action traded above 50% here. What did it do? It sold back into what? 50% discount. What happened? price bought into premium again. So we are in a premium. But not just the Fibonacci, you are looking at institutional reference points that are in a premium market and has the potential to support price lower. Or if you are buying, you are looking at potential institutional reference points that are in a discount market that has the potential to resist price higher. So right here, what did we see? We now saw that price action actually traded into previous mitigation block right here. Do you know how to identify mitigation
block? No. Sorry, Mr. Francis. Remember I said that I would like to, I don't know how to identify mitigation blocks. So, but I remember, I don't know if you read my chat, that I would like you to take this section as though you're teaching someone who is new to.
I understand.
Okay, so the
that's how I prefer that we had gone through the video so that as we're having the session, I'll be bringing clarity and expertise on how to use them. Okay?
Okay, so going forward, I think I would, am I supposed to go through all the videos at once or according to classes?
I sent you.
Sorry?
The videos on the Google Drive I sent you.
Yes.
Those are the videos I want you to go through.
Okay.
If you go through that, you'll understand everything about smart money concepts. And they are not really much.
Okay.
Okay, so
I'll do that before the next class.
There's something called institutional reference points. There are specific levels that institutions actually trade from one point to the other, to the other, to the other, and there are 7 of them. And in their order of importance, first is the mitigation block. Second is a breaker block. I said first is what? Mitigation
block.
Second is breaker block. Third is liquidity void. Fourth is fair value gap. Fifth is order block. This is where most people get it wrong because most people only focus on order blocks. Sixth is called rejection blocks. Then the last is an old high or old low. Okay, 1, 2, 3, 4, 5, 6, 7, correct. So what this means is that if we're in a premium market between a high and a low on a Fibo level, we are looking for this thing I just listed.
Okay.
Above the market, at the same time, below the market. So if we are selling, we'll be looking for what is the mitigation block that we see above. You start by looking for mitigation block because that's the first in its order of importance. It doesn't have to be there, but if it is there, you will pay more attention to mitigation block because in order of importance, it has more structural potential. Do you understand? To resist or support price.
Yes. Yes.
So if I was looking to sell because I see price action trading into a premium level, I'm looking, is there a mitigation block? Yes, I'll start looking for how to sell around the mitigation. If it's not there, is there a breaker block? If it's not there, is there a liquidity void? It needs to be rebalanced. If it's not there, is there a fair value gap? If it's not there, is there an order block? If it's not there, is there a rejection block? If it's not there, is there an old high and old low? These are the things you're looking for.
Hello.
Maybe lost connection.
Yes, I lost connection. Sorry.
Yeah, so these are the things in the videos. I really explain how to learn about each of them. All right, but for purpose of this, let me still teach you how to identify mitigation. So remember that there's something called market structure. I'm sure you know, right?
Yes.
Market structure forms higher high if we are bullish, higher low, higher high, higher low, higher high, higher low. That means normal bullish market structure should continually form what? Higher highs and higher lows. In the event where you see that it failed in taking out the previous high, it was finding it difficult to take out the last high, then created shift of market structure bearish. At this moment, what you just have is price action has created a bearish mitigation block. Why is it a mitigation? Because there was failure swing before shift of structure. These are the characteristics of a mitigation. Failure swing before what?
Before shift of structure.
So you expect
Market structure shifts, right?
you want to see price trade back into that mitigation block, or with confluence of another institutional reference point around that level before we sell. So as we are selling, we are forming what? Lower low, lower high, lower low, lower high, lower low. A normal bearish structure should form another lower low, but in the event where it failed in taking out that old low and creates change of market character or shift of market structure, what you have now is called what? Bullish mitigation block. And the mitigation block is that last high that was violated, the last lower high there that was violated. Is that okay?
Yes.
We want to see price trade into it before we buy.
Okay.
So look at this. What do we see? Price action was bullish here, was forming higher high, higher low, 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 lower high. Couldn't take out that high. Then what happened? Shift of market structure.
Shift of market structure.
Sold. You see that? So what do you have here? You have a bearish mitigation because failure swing happened before the shift of market structure bearish. Did you see how I outlined it?
Yes.
Price action returned back into that mitigation, even though it took like how many years? Almost 3 years, but it finally did, or more than. Then what happened as it traded into that level? Premium mitigation, the dollar started to what? To sell. So previously, the dollar has reacted off a bearish mitigation block in a premium level here, which is a point of interest for sell. And we see the dollar right now. What is happening? Because remember, I said you are looking for 3 things on the monthly. Where has the dollar traded away from? Where is it currently? Where is it heading to? So now we have identified where it reacted off in time past. It traded off a bearish mitigation. Where is it currently? The dollar is taking out the lows of the monthly candle. You see that? Clean sell displacement happened. The dollar consolidated for a while, traded back into a fair value gap right here. Just manage this lesson so that after the lesson, you go through the videos, please.
Okay.
All right. So price traded back into that fair value gap. What happened? Selling. Look at how every time price wants to sell, it's the momentum of the sell candles is larger and it's taking out the previous lows, the lows of the previous candles. Traded back into bearish order block. What is happening currently in the last 3 months? The dollar has been taking out the lows of the monthly candle. Is that okay?
Yes.
So we know that the dollar is what? It's bearish. Why? Because it has been taking out the lows of the previous candles. So what is the last thing? We said, where is it heading to?
Yes.
We said that let's look at drawn liquidity either above or below market price. So since we know that currently we are bearish, we are going to identify sell side liquidity pool, which is below 3 things: old lows, relative equal lows, or equal lows. This is an old low. This is a relative equal low around this level. We'd like to see the dollar trade into that level. Is that okay?
Yes.
So on the monthly, we know that order flow is what? Bearish. And look at this. If you pick up your Fibonacci between this last swing low that happened before this structural shift here. Are you seeing this?
Yes.
This is the current range, right? We are trading in.
Yes.
Where is 50%? This is 50%.
Wow.
That means we still want to see price action. We are in a premium. We still want to see price action trade into deep discounts. this bullish
Some
mitigation
discount.
block here. You see that
Okay.
mitigation block there? Why is it mitigation?
Mhm.
Failure swing, shift of
Failure
stock.
to take over the highs. Mhm.
Exactly. So we like to see the dollar trade down into this level. Okay, but we know that the dollar is going to form its lower low, also lower high until it gets here.
Mm.
So monthly, we are bearish. Then on the weekly time frame, what are you looking for? On the weekly, you are looking for price action to form expansions in the direction of the monthly time frame. So since we are bearish on the monthly, we want to see the weekly time frame forming lower expansions, bullish retracements, low momentum, bullish correction, lower displacements, higher retracements. Is that okay?
Yes.
So look at what happened. Price action has been forming lower lows, lower high, lower low, and price currently it took out an external range liquidity below that low. That old low here is a liquidity pool. And every time an old low or external range liquidity is taken out, we like to see price action returning to internal range. All these things are in my videos. Okay. So now we have taken this. Are we just going to continue selling? Yes, but we need to see this also retrace. Let it take some new breath before it continues expanding. Is that okay? So what level do I see this going into? I see that previously there's a level of support here that has been disrespected. What do I mean? Look at this, relative equal lows, relative low here, another low. About 3-4 times we have price action rejecting at this level. Then finally it traded below that level with so much momentum. This is a typical of something called support that becomes resistance.
Okay.
Okay, so we like to see price action trade back into that level before we continue selling.
Okay.
Into this level before we continue selling.
Okay.
Why? Because we see another range here. Look at this current range on the weekly. High to the low. Where are you? Are you in a premium?
No.
That means you shouldn't be selling. Even though you are bearish on the monthly, you will wait until this gets into a premium level on the weekly, then you do what?
Okay, you know, so.
Does it make sense?
Okay. Yes, it does.
Good. So on the daily time frame, what are you looking for? On the daily, you are looking for market structure. Very simple. We need to see price action form lower low, lower highs in a bearish market order flow of the monthly and weekly, and we need to see it form. We need to see it form higher high, higher low in a bullish scenario. So since we are anticipating that the weekly is going to retrace into that level, what are we expecting? We're expecting that the daily should create a bullish market structure. And this is what I see. Price has been forming lower low initially, lower high, lower low. Did you see that?
Mm-hmm.
All of a sudden, what do you see? Is that shift of market structure bullish?
Yes, it is.
Because the body of the candle has closed above the last.
Closed above. Yes.
Correct? So we are going to wait. Are we going to just buy from this level? No. We are going to also pick our Fibonacci from that low to that high. Wait for it to get into a discount of this current range, then we buy. So did it get into a discount level? Yes, it did.
Yes, it did. This candle. Below
50%. So what are you looking for below 50%? Remember, I said institutional reference point. Do you have a mitigation block here? No, you don't. Do you have a breaker block? No, you don't. Do you have liquidity void? Yes, you do. This is a liquidity void, one-sided price delivery. It's all buy. It's void of opposing liquidity.
Yes.
You have a fair value gap? Yes, we do. Look at fair value. Look at Do you have a bullish order block? Yes, we do. Look at bullish order block right here. Did you see that? So it makes sense for us to wait. Price action traded into that bullish order block on Friday. NFP news traded up again. Today, it looks like price action is still wants to retest this level, but because it is Friday, we know that nothing serious is going to happen. And also because on the fundamental, there's nothing serious today. Now, did you see that price action is technically creating drawn liquidity here, equal highs? Are you seeing this?
Yes.
Retail traders will see this as a level to sell. They will call this resistance, but this is not resistance. We see this as liquidity. So I would like to see price action pierce through this level with so much momentum into that level. So it will do this, then this becomes support.
Okay.
And we buy.
Okay.
Does it make sense?
Yes, it does. Wow.
All right, so I think we just have 2 minutes. So this is where we'll stop today. Basically, order flow is very important. 3 time frames we are looking for: the monthly, the weekly, and the daily. On the monthly, you are studying where price has traded away from where price is currently by looking at the candles. Are they taking out lows? If they are consistently taking out the lows on the monthly time frame, it tells you that you are bearish. Then what's the next thing you need to do? You need to identify where it is going to. It's called the draw liquidity. So if you are bearish, you identify the next sell-side liquidity pool. If you are bullish on the monthly current order flow, you need to see the candles take out previous highs on the day, on the monthly candles. The more highs it takes and it's finding it difficult to take out lows, it tells you that there's buy momentum. All right. So what is the next thing? Identify where it is going to. Knowing where it is going to is more important than anything in trading. So that's why when you are studying the video about liquidity, pay attention to it very, very well, because you need to know where the liquidity is, where the money is residing, because that is where the banks, the institutions are most likely going to go to. Okay?
Okay.
And on the weekly time frame, we are simply looking at price action creating expansions in line with the monthly order flow. If we are bullish, we like to see price action create bullish expansions, bearish retracement, just more like say market structure on the weekly. But this time around, we are focusing on expansions and retracements. But on the daily, we are focusing on market structure, shift of market structure, returning to internal range. That's retracement, then expansion again, retracement until an objective is traded into. This will be the end of our class today. Please, I encourage you to go through the videos.
Okay.
And let me know.
Rest assured.
Once you are done with the videos, let me know. Or once you cover quite a good number.
Okay.
Okay?
Okay.
Before next Saturday.
Sure. Sure.
Then you can always reach out to me in the WhatsApp group. WhatsApp.
Okay. Okay.
All right then.
Okay, but one question before I go. I usually will hear you people say ICT said as so who is ITC or what is ICT?
ICT is Inner Circle Trader. He's the founder of Smart Money Concept. We all learned from him.
Okay.
He actually stopped doing paid mentorships, I think about 2 years